Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs report and how that might impact spring housing demand. Logan, welcome back to the podcast.
It's wonderful to be here. This is done on Tuesday morning, right after the job openings data report. So very fortuitous in timing because we're going to talk about like how to gauge spring housing demand, especially now that rates are elevated and what to look for. But wow, boy, we just shot right to the kind of the 2025 peak forecast of the 10-year yield around 470. Mortgage rates are not quite at 7.25 yet because the spreads are better this year, but it's just going to make 2025 even more interesting now that this dynamic is here.
Okay, so let's back up a little bit. So this last weekend, you wrote an article. The tracker was about, did the spring season start early? Did it already start? Did it actually start in November? So tie this in with that.
So what we've seen in the last few years is that November and December purchase application data grows. And then it funnels itself into, in 2023, we had one massive existing home sales report early in the year, 500,000. 2024, we had two reports, right? They equated themselves together to roughly about 500,000 from the low. So the February report was kind of the peak. We even wrote about that saying that, okay, this looks like the peak of home sales for me at 4.38 million. Until mortgage rates fall, right? And what occurred is rates stayed elevated throughout the year. And then in the kind of the summertime, mortgage rates started to fall. And then it started to hit the data lines. And now we've had 4 straight months of pending home sales growth, existing home sales growth back to back. And now we're doing this again, right? Because we work off channels, off mortgage rates and the 10-year yield. And a lot of that is really depending on the labor data, right? So the whole paper, rock, scissors, labor over inflation, the Fed's not going to really pivot until the labor market breaks. These kind of things kind of held its own, and we're kind of just doing this back and forth with housing data. And now that the 10-year yield is here, it's very similar to what has happened the previous 2 years. Rates tend to move up kind of in the spring, summer, and we need to be able to see what is it doing right now? Now that we're in year 4, right? We've had 3 years of the calendar lowest home sales ever, adjusting to the workforce. Now we're in year 4 and the data was getting firmer. Oh, Sarah, if mortgage rates were just at 6%, the world isn't going to end, nothing's going to, but we got a whiff of what the Fed really thinks about the housing market in 2023, even though they publicly won't say it. Neil Kashkari blurted it out. So
in 2023?
In February of 2023, when Neil Kashkari came on CNBC and said, mortgage rates are heading to 6%. There's some life in the housing market. How are we supposed to balance an economy if the housing market and people are buying homes and they're having sex and, no, what are we supposed to do? So honestly, that was a frankly very open view. And when I tell people, I say, guys, have you ever heard the Federal Reserve says nothing about housing? Really? It's one thing if it was like home sales are down just a little bit. Dude, we've had the biggest crash in sales. This is the third going into the 4th year. They just kind of leave it alone. This is on purpose. And I think Neil did a really good job explaining what their mindset is, because the last thing these elderly people fear is Americans, young Americans buying homes, having sex, having kids. That is inflationary, right? An inflationary economy grows, not a deflationary economy. Can't get the job done, right? So I think this is why I've always said labor over inflation. The Fed will be as tight as they possibly can be until the labor market trigger breaks for them. And there's things that they kind of really track for that. So it's not shocking, but I just so much frustration this morning, when that happened. But this is the world we live in. And these are the rules we have to work out. We can't just throw them away because we don't like them. We just have to model ourselves, our housing takes around what I believe they're looking at or what the bond market is looking at here.
So when you look at the spring housing season now, given this information that we're going to have, rates over 7, maybe 7.25, up at the top of our range for the forecast for the year. What does that mean for sales.
So this is the interesting part. In November and December, rates were rising. Okay, so, and the forward-looking demand was fine. I mean, it wasn't spectacularly growing, but it was improved versus 2023, 2022 and 2023 data. I believe that's seasonal. It's interesting because like 2 years ago, I went on CNBC like in 2023, and they said that, oh, purchase application. I said, I think that's just a seasonal demand curve. I'm trying to like talk about that again here. What you need to see going out for the rest of the spring is the forward-looking data still being positive to grow sales. What's happened in the last 2 years is that didn't occur. Really good example, what we try to show in the tracker articles each weekend, especially in 2024, when mortgage rates went up higher, 6.75 to 7.5% in 2024. Purchase application data had 14 negative prints week to week, 2 positive, 2 flats. Then when mortgage rates went down towards 6%, we had 12 positive prints, 5 negative, 1 flat. So you could see it in the data lines of forward looking, and then it hits our contract. But we're working from such low levels that when you create over 6 million new jobs, household formation, dual household incomes, everything that, you just kind of get that little bounce. The question is, now that we're going into spring, how does it look? And this is why the tracker is very critical, especially early in the year. We'll get an idea of how the spring season, now that rates are elevated, but rates have been rising, for some time now. So far, it hasn't like crushed sales, but it hasn't really crushed sales for some time now because we're working from such a low level that it doesn't take much to move the needle on the positive side.
Also, I mean, we've talked about this before, but at some point we're just going to reach a critical tipping point where people who have been holding off, trying to wait for better rates, they just can't for various reasons. You always make the case that there are demographic things that happen that push people into homeownership. And if you've been on the sidelines for a couple of years, like you just at some point have to jump in sometimes.
Sarah, ask me what I think about the sideline home buyer.
No, I'm not going to ask you what you think.
Ask me what you ask me. Come on. Oh,
no,
please,
it
just for me.
triggers you.
Just for me. Ask me what I think about the sideline.
Okay, what do you think about sideline home buyers?
I think Bigfoot, the Loch Ness monster. Actually, I do think
Whatever.
Bigfoot is I think Bigfoot is real. Actually, it's the missing link. The sideline home buyer, I believe, is a marketing myth. Millions and millions of people buy homes every single year, right? I mean, even 2023 and 2024, we've had near 5 million total home sales. So when people say, well, nobody's buying homes, we have near 5. I mean, it was 2 million, in the 70s before the baby boomers came in and took that to 4 million, and then rates went up and crashed sales. So I think the better way to look at this is that the buyer pool grows with lower mortgage rates because it becomes more affordable. And when we look at economic cycles, especially in the last 14 years, after qualified mortgage was put in, you can't just go, honey, we're just waiting for 7 years. Let's just do it. No, I mean, if you can afford the house at 6% or 6.5% or 7%, and you really need it to move, you do it. The question is, can you afford it? Because qualified mortgage,
right.
It's all over. Everyone is legit now. So the buyer pool gets bigger because more people can afford it in that. So I'm just not a fan of the theory that people are sitting and and just all of a sudden,
this is where we disagree. And I just think it's a matter of semantics. You want to say, because people have used that in a certain way, it's a marketing gimmick. But the truth is, if you're a double income, household, even if you're not, if you have to move, you find a way. Maybe that means you put off all these other things if you can afford it. So we're saying, yes, we're saying people who can afford it, but there are people who are relatively speaking, can afford it, but are it just seems like a bad deal. And then they're like, we've got to go ahead and do it.
Or they rent.
Yes.
Yes. Yeah. And that's why I don't believe in the sideline home buyer. People can move freely anytime in the last 10 years. The nested equity position of homeowners are unbelievably good. So they can easily sell their house and rent. And in a lot of cases, rent would be cheaper than buying a home in certain areas of the U.S. particularly. So I just think there's a natural flow home buyer. This is why we had that 4 million level, right? We talked about that 4 million level in 2020. That,
Right.
it's just really rare in America. Now that was COVID, right? Everybody stopped living for a few weeks, and then things got right back up. But even here that we've had the biggest crash in home sales ever, it's, rates have been hovering between 6 8. We don't really go too much lower than 4 million. We've had a few prints underneath there. So we're just hovering around here. I just think the buyer pool gets bigger because more people qualify. I just don't believe there's somebody sitting there for like 5 years. Sarah, could you imagine if, you're sitting there and you're talking about, oh, we should move. And they're like, we're just going to wait for rates, and rates get down to 6%. The guy doesn't pull the trigger. And then here 6% again, the guy doesn't pull. No, I mean, that's just not the case. I just think there's a bigger pool of home buyers when rates get lower, more affordability, and they go. And also remember, most sellers are home buyers. So
Right.
the math has to make sense. This is why I'm not a mortgage rate lockdown person. I believe there's a portion of the society that literally cannot move because they don't qualify. And there's another portion that go, wait a second, I have a $2,000 mortgage payment total. If I move now, that's $5,000.
Some of us would call that the mortgage rate lockdown theory,
it's
Logan
not
Mohtashami.
because the mortgage rate lockdown is only one variable, and the purchase price, the taxes, the insurance, the loan balance size, the things, the whole enchilada, Sarah. That's why I say the mortgage rate lockdown is a marketing gimmick too. That's how total housing costs, right? It's everything, right? And there's a lot of people right now, property taxes, especially I know here in California, like if I had to move, right? Of course, everything else is cheaper. Like the world is so cheap. If you live in Orange County, California, you look at everything else. Right? I even Austin, Texas, I go, God, it's so cheap there. But for a lot of other people who don't live in the coastals of California, moving, property taxes, these things all go into play. I just think what we've seen is that the buyer pool gets a little bit bigger when rates go lower. And then when rates go higher, the buyer pool falls down, and we're just kind of stuck here. But over time, and the reason I say this is that over time, dual household incomes form, and you just get a little bit buyer pool by the sheer size of the workforce in that dual household income. And if home sales, let's just do a hypothetical. Let's say mortgage rates stay between 6.75 to 7.5, like they did last year before rates fell, and home sales are up just a little bit more than last. Hey, this just that middle class buyer just comes in and buys homes.
So, when you look at the spring, put yourself, you're the loan officer out there, you are the real estate agent out there. I think it's confusing for people when they're like, okay, I thought it, we're seeing more demand. We just saw a good consumer sentiment. Does one day of rates going up, does that, this jobs report, does that change all that? What should I expect?
If you don't read the tracker, you're going to be lost. And we've said this for 2.5 years, that the tracker is the only pure market-driven data line that correlates to housing economics, not what people perceive it to be, but it actually is a marketplace of data lines coming together. This is why I always say that this is the best way. If you're a loan officer and real estate agent, you can literally see what the marketplace is doing, not what you believe or perceive to believe it can happen. So in this case, like what do we know about housing in the last few years? Why are the builders' home sales so much higher than the existings? They offer lower rates, right? So the seller's credits, getting mortgage rates lower, you make your house more appealing for a home buyer. The builders do it. Why? Because the builders sell their homes as a commodity.
Right.
They take the human element out of the equation. It is just money. Home sellers, on the other hand, my home is X. Why? That offer is nonsense. And, you're dealing with variables because it's just different. Now, efficiency is, I always say the home builders are efficient sellers. I'm just making this house. I'm ready to sell it. I'm not going to sit there. I mean, we've had times where people put their homes and leave it on the market for like 4, 5, 6 months, and then they take it off, right? Not the most efficient sellers, and they don't need to be, right? They're not forced to do anything, obviously. And again, if you had to move and you couldn't sell to buy now, you could literally sell your house and rent. So there are choices there. I just think the marketplace operates in a much different world than the existing home sales market, than the builders, right?
Right.
And we have such a gap in sales data between the new home sales market and the existing. But the builders found a way, and it's really just lower rates. I mean, could you imagine if the builders didn't have the profit margins and they couldn't do the lower rates things? Home sales, new home sales would be lower, housing permits would be lower, and residential construction workers would be at more at risk. But they were able to do it. It's, the question is, I don't believe they have the luxury to do it as much in 2025 like they did in the past few years. So it just makes the housing market more interesting.
It does. Okay, so let's talk about, when we're like, are we already seeing spring demand come up? From your perspective, looking forward with the jobs, knowing that rates are, potentially not going down anytime soon, do you expect that to hold?
So far, it has held. So far, it has held surprisingly better than I thought. But if that keeps on continuing, this is why every weekend we look at that pending contract, we look at apps, and we look at forward, especially after the second week of January. Right, the spring is going to be kicking into gear, and we'll see any of the. If it doesn't hold, you're going to see purchase application data will go negative, and the pending contracts will get softer when you put those two combined. So as of right now, it is held throughout this November and December, but you also have to remember you're growing from a very, 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 very low bar, and just the sheer size of a dual household income coming in can give you that extra nudge and buyer. But if you're looking for growth, right, we've only seen really authentic growth when mortgage rates get down towards 6%. We've seen home sales grow higher, sale levels higher, when it's a sub 6% mortgage market. The builders have shown you that. So we have things we can work and model on, but it's just that now that we're here again, I don't know, somewhat similar to last year. Last year, mortgage rates went from 8% down to 6.63%, went back to 7.5% early in the year. During that period of time, after we had that initial seasonal demand push, home sales peaked in February and trended lower the rest of the year until mortgage rates fell. So again, we can track this, and this is why I think the tracker is more important for something like this, because if mortgage rates were down to 6%, hey, we're fine. We could keep on growing. But now that are here, you want to kind of see how buyers are reacting to it. What do sellers have to do? Again, we had 5 million, near 5 million total home sales. We're going to have that somewhat again, and in that context, there are people there. The question is, how good are you in Hungry Hippo to snatch that up? So that's why data matters. It gives you a real-time live equilibrium. You don't want to wait for the existing home sales report and go, oh, there it is. That's too old. You want to be fresh weekly data, and then you go with it.
So we have a week before we have that, what you would consider. Now let's look at those numbers, right? Middle of January. So a week away from that. We're 2 weeks away from an inauguration and potential wild cards coming into this that could move mortgage rates, right?
10-year yield got to 5% in 2023. We had 8% mortgage rates. Why did that happen? The Federal Reserve went hawkish at a key technical level. The labor data got better for them. That drove the market. Political economic theory, I'm just, here we are right now. Why is the 10-year yield at 470? Well, look at the job openings data. Job openings data firmed up, except the internals of the job openings data, it's getting softer. So you have a divergence in that. That to me matters more than who's the president. And it will always matter to me more than who is the president. I know a lot of people are saying the Trump tariffs and everything, but literally we had a 5% 10-year yield and 8% mortgage rates. President Trump was not president then. Why did that happen? Those are the things that move economic cycles, right? And what occurred in 2019 is that the trade war tap dance crushed business investment. And if you want to look at negative revisions in recent jobs data, go back in 2019. It was a lot worse back then. So there's limits to what can or can't happen with a new administration and a new policy. But for right now, for today, the labor data ran it. And let's talk about the job openings data.
Let's do it. What does it look like? Tell us why you're looking at the internals where there's a divergence there.
So this is the big fight this morning. On one hand, the job openings data, the number itself, was falling very rapidly, and it stopped. In the last few months, it's been holding up. What has also fallen, wage growth was falling very fast. It stopped, and it's firmed up. So the Federal Reserve likes the job openings data because they think of it as a kind of a heat map of where the labor market, if it's too tight, too loose. However, the internals of the job openings data is like really getting weaker. Like the hires are falling. Technically, you're at like 2008 early recessionary data line. The quits percentage, which the Fed completely freaked her out. I mean, my God, people quitting their jobs and getting better paid jobs. Not under this Federal Reserve. No. How dare you? How dare you, Sarah Willie, think you could quit your job and go get another better paying job? What are you, in that case, the quits percentage is now pre-COVID. So it's really, I could understand the frustration by some people. You have the two data lines that the Fed told us to track be noticeably weaker, and then you have the job openings data firming up. And then here's a 10-year yield at 470, right? So it's like if somebody in 2022 said the Fed really isn't going to pivot until the labor market breaks, that they will talk about financial conditions being as tight as possible until labor. Oh, wait, we did have someone. In that case, look at it in that context. And always remember, the Federal Reserve came on TV and said, we track jobless claims, and jobless claims went lower. Sarah, what data line just went down to a very low level? Jobless claims, right? So the jobless claims data. So it's frustrating. I get it. I think the job openings data really confused a lot of people because, you could see that the labor market's getting softer, payroll growth is getting softer, and then you lose one or two sectors, your unemployment rate's going to go up. This is why I fundamentally believe that the Fed kept that unemployment rate, target at 4.3%, just in case if you start to lose some of the things, you can switch it. And then all of a sudden the 10-year yield goes down again. And the builders are happy, and then home sales grow, and then construction workers might be employed, so stuff like that. So it's just, I've seen this in every economic cycle, and the Fed tends to ignore the housing data late in a cycle, and they come after the fact. So especially with this Federal Reserve, I just think they're just basically acting kind of in line. Their early labor triggers haven't hit warning signs yet. So that's why they tell you, hey, we have new ways of tracking things. We call people up and go, are you firing anyone? Literally, they tell us this. They say, we call people up and ask, are you firing anyone? No? Okay. Hey, we're good. So it is what it is. This is just the world we're dealing with. We try to do our best, but the whole Fed won't pivot until labor breaks, labor over inflation. Here's a good example. Growth rate of inflation has fallen off. The 10-year yield is at 470, right? So we had similar things happen last year around this time where we talked about inflation data gets firmer in the early part of the year, and then we just move on with it and we work off channels.
Amazing. Well, Logan, thanks for being on. Even though I disagree with you on things, as always, you are the data analyst.
I'm the chart daddy, so you should just remember that. I have data to back me up. You have a theory.
I do have a theory.
You got a whole mortgage rate lockdown. Just by the way, for anybody that we have a lot of new listeners, the mortgage rate lockdown was that inventory cannot grow because nobody would sell their homes.
Okay, that's how you define.
No, that's how people talk about it. It's not. Mm-hmm. It's not that demand doesn't higher mortgage rates obviously impacts demand. Lower mortgage rates impact. That's it. But the whole notion was that nobody was going to sell their house, and yet we had people selling their 3%, 4%, 5% mortgage coupons to buy. And inventory grows with higher rates. Actually, it's really interesting. Mike Simonson and myself have a very, very different take on the inventory channels, but we have a similar take on the higher mortgage rates. I believe it's just the credit markets changed after 2010, and he believes that people just will hold on to their properties more because they have such a low rate, and then the higher rate, that changes the variable. That's completely different from what I think. But again, I've got 14 years of data to prove mine, and I'm willing to take anybody out on it. Wait a second. We were debating on stage.
We did debate on
Guess
stage.
who won? Can we have a hands raised for the winner of the debate of the mortgage rate lockdown between Sarah Wheeler and Logan Mohtashami? Who was it?
It was pretty rough, but I have had a lot of people since then say, I still think you're right and Logan's wrong. So just going to say, if we're doing a popularity contest, well, okay, if we're doing a popularity contest, you're going to win. But if we're doing a popularity contest on the mortgage rate lockdown, I win. So
listen, there are a lot of people who want to see me lose, and I totally agree with them. I get your frustration with me, but a lot of people have tried, and I say, bring it on, baby.
All right. Well, we will talk again soon. Thanks for explaining all of the jobs data, especially, and what's happening with the spring market. Appreciate it. And of course, everyone, plan on coming to Dallas February 26th to our economic summit. Logan will be our featured speaker. We'll have Mike Simonson, we'll have Barry Habib. We have all these amazing economists coming to break down the different data. So be an amazing day. All right, Logan, talk to you soon.